All right, on to lesson three. Now you're going to decide how are you going to fund the deal. I'm going to have multiple modules dedicated to different types of financing, which we're going to cover in a lot more detail. I'm a mortgage broker, so this is definitely my area of expertise. I really like digging into the financing side of things. There's so many creative ways to do it, so many different things you can do to get the deal structured. Here's a few different ways that you can finance a real estate purchase. Number one, it's going to be pretty obvious, is cash savings, but most people don't have that. So let's move on to some other ways you can fund the deal. You could leverage other assets like your 401k, life insurance, stocks, real estate. So if you don't have the cash, you can actually typically get a loan on your other assets in order to pay cash on this purchase. And there's a lot of benefits to being able to write a cash offer, even though you're still getting a loan from one of your other assets, but you're not getting a loan on the subject property you're buying. There's benefits to that because the sellers know that there's not going to be an appraisal on the home. And to them, it seems like it's a lot more sure of a deal. You're not going to get a mortgage that you have to apply for on the property they're selling. So cash offers are great, even if you are having to get a loan on one of your other assets. Another way to do it is going to be a conventional mortgage. So typically on an investment property, that's going to be 15 to 25% down. You could buy a primary residence also and put really 0 to 5% down. There's a lot of different programs for home buyers. If it's your primary residence, you can't lie and say it's going to be your primary residence and then turn it into an investment property. That would be fraud. That'd be bad. Um, but you could live in the property and then convert it to a rental later. That's totally fine. If you're doing a primary residence loan, though, you're expected to live in that property for a year or more. Another loan you can get is a commercial purchase loan. So that's a little different than a conventional loan. A commercial loan is going to have usually 20% down payment, pretty close to what you'd put down on a conventional loan. But there's going to be some more risky features with these types of loans. The commercial loans are typically only fixed for 5 years and on a 20-year amortization. It's not going to quite cash flow as much, maybe as a 30-year fixed conventional loan. But there's benefits to using commercial loans. It's good to have a commercial banking relationship. They're usually a lot more flexible on uh, the situation when it comes to maybe the property's a little more beat up. It's a flip situation. Maybe you're going to refinance after you fix it up, pull some cash out. Commercial loans can be a little more flexible if you're doing a lot of burrs. Burr method, we'll talk about that later. Another way you can finance a property is through a private lender. If you can't get approved for a commercial loan, you can't get approved for a conventional loan, you don't have the cash. If it's a great deal, you could probably find a private lender that will lend you the money on the deal. Their terms is going to be higher interest rate, typically more fees and more risky features. I mean, I would say you want to probably start with try to get a conventional loan, or second, try to get a commercial loan, and then use private lender if all those don't work. But every situation can be different. There are private lenders that maybe work with flippers that can offer you some really great terms. Um, Another really creative way that you can finance the deal is going to be through seller financing. So sometimes you can go to the seller, purchase the property off of them, and you actually pay them as the bank so that they don't necessarily receive all that money right at once. So there may be some tax benefits to, let's say, a retiring or high net worth seller, where they want to kind of stretch out that sale and collect interest from you instead of you going to get your own mortgage. And a lot of times they'll let you put less money down through seller financing. And like I said earlier, they're the bank, so the terms are going to be whatever they decide. So that's going to vary quite a bit situationally. Another way you can finance the deal is getting a non-QM mortgage. So that means non-qualified mortgage. It doesn't meet the conventional loan standards. That would be something like a DSCR loan, debt service coverage ratio loan. and they're just looking at the cash flow from the property on that. And then also you're going to want to have good credit. Having good credit is going to help you with any type of loan. I mean, if you're getting investment properties, you should keep your credit above 700. There's ways to do it with credit below that, but if you want to get a good deal, you probably want to be in the mid to upper 700s. Even 720, you'd be fine, still get a good deal. Um, Another way that you can finance these properties is going to be through a cross collateralized loan. So if you own multiple properties already, and let's say you've got a lot of equity in them, a local bank or a commercial lender might say, "Hey, I'll give you a cross collateralized loan. That means I'm going to take a loan out against all your other properties so that you can maybe pay cash on this one for the purchase." So if you've got a lot of equity, people will give you loans. Equity, good credit, cash flowing properties, the banks and other lenders are going to be willing to lend you money. Um, Another interesting way that you can fund deals is through syndication. And syndication is raising money from other people, groups of investors to make a purchase. That's really common in multifamily real estate. So when people are buying, a 500 unit apartment complex, they might be raising money from 50 to 100 different investors. A lot of time you're going to need to be an accredited investor, where you're typically going to need to have a higher net worth or show that you make a lot of money, and it's higher than it would be for a regular average person. But we'll get into more details on what the requirements are for being an accredited investor on another lesson. But another way you can buy the deal is through a partnership. That's pretty simple. It's just you and let's say two, three, four other people together. You're going to say, "Hey, we're all going to just go in on this deal together." We're not necessarily raising money from outsiders. We're going to come up with it ourselves and then share the management and ownership and investment rewards all together. So partnerships can be really good sometimes. They can be really bad sometimes. So you got to really think about who you're going into business with if you're going to do a partnership, and not just do it with anybody, because it's kind of like a marriage. It's a long term deal, and if you break up the partnership, it's kind of like getting divorced, and it's not always pain free. Let's just say it that way. But that's definitely something to keep an open mind about, because more people working together are going to be able to make more deals happen, make more money together. So we're done with this lesson. We'll move on to the next one.